Hey guys, John Pauly here, Actionable Intelligence. Today is Sunday, December 6th, 2020, and this is the weekly market update. Okay, the disclaimer, of course, in these times we need to have a disclaimer. Content in this video is for informational and entertainment purposes only. Should not construe any such information or other material as legal, tax, investment, financial, or other advice. So nothing in the video constitute professional and or financial advice, nor does any information on the video constitute a comprehensive or complete statement of the matters discussed. It's your money, so it's your responsibility. So this week, well, first I wanted to have this shout out for the channel and AIA. This was on Twitter. This is from a subscriber of mine, but also somebody that watches the channel. Goes by the moniker Aloysius Snuffleupagus Baggy Pachyderm LLC. Anyways, he's talking at John Pauly is a must follow for his weekly update. I'd listen to him reading bedtime stories. Talk what you want about his picks. He's talking about the picks in the newsletter. I keep a watch list of his picks because I'm a subscriber, and the whole thing effing gapped this week. He put out AR, that's Antero Resources, for free when it was $3. So basically, appreciate that. Any subscriber that tells me we're doing a good job. We've had constant ongoing subscriptions, but we've had, a lot of people that don't renew their subscriptions. And that's for a reason. For the last year or so, year and a half, the portfolios really struggled. Why? Well, value was out of favor. Things that were in favor were not things that I would buy. I'm a long-term contrarian investor / speculator. Now, many of the picks in the newsletter are speculations. There's a difference between investing and speculating. But in fact, our thesis, as we've laid out here in general on the channel, is that we're at the cusp of a long-term, probably 5 to 10 year resource bull market. Underinvestment in commodities is going to lead to a sustained and long-term uptrend in many resource prices that should drag a lot of the resource stocks along with them. Many of these companies have been down, 80, 90%, and they basically were given up for dead. And so I believe we're seeing a shift back towards resources because of the underinvestment, and added on the fuel of central bank largesse, where trillions and trillions of currency units are being printed out of thin air. So you guys know the story. But anyways, yeah, I would say it just didn't gap up this week. I mean, the portfolio's basically been trending upwards. It's been beating the S&P since last quarter. Q3 was a beat, and we're beating the S&P this quarter by, I think I looked at the data, the portfolio as a whole is beating the S&P by 3 times. I think the S&P this quarter is up 8% roughly, and the portfolio is up about 22 or 23%. So just in this quarter. So look, the portfolio stocks are going to be very volatile just by their nature. Many of the type of stocks that I'm speculating in, they can go up or down 50%, positive or negative in the space of 6 months, based on no news, just based on liquidity. These are a lot of times smaller companies they have to have some news flow. But when we get into a trend on some of these things, like the uranium stocks, I believe like all the uranium stocks in the portfolio are now positive. One of them is up over 100%, not just in the 3 months, but since we've held it. So that's pretty good. We've got, I've got a royalty company in there that's up over 300%. And we've had some dogs. We've had some companies go to zero. So that's what you're going to get in the portfolio. How do we control that? How do we control the overall returns and get a positive return? By position sizing. I'll take an initial position, initial tranche in a company that I think has potential. It's not my full allocation. I just take a taste of it, and then I watch it. And as the business turns around, if it turns like I think, and it actually starts showing an uptrend in the stock, then I'll take additional tranches as I feel. And sometimes that works, and sometimes it doesn't. but these are longer term plays. These aren't something that are going to play out in a week or two. I got lucky on last month's pick. It's already up 50%. It's a play on the country of Georgia. But the thing was bombed out. I love country picks. I love it when a country is like gets bombarded with bad news and the stock market in that country drops by 50 or 80%, like happened in Greece or Cyprus. And people just assume the country and all of its people and all the assets in the country are just going to dry up and blow away. Well, that never happens. Eventually, time heals all wounds. So, COVID has provided a lot of opportunity for those type of situations. That's one of the functions of the CAPE ratio that I like. I like to use that, but these are long-term things, and that's why people don't like them. People want, that dopamine hit. They want something to happen right now. I mean, people get mad if they have to sit in the Chick-fil-A drive-through line for 5 minutes. Trying to get somebody to say, have a 3 to 5 year or 10-year time frame is just not going to happen. But for life-changing wealth, that's what's required. So I appreciate the shout out, plugging the newsletter a little bit. Look, this is one of the things that I probably shouldn't do. I shouldn't be telling you the kind of great returns they're getting right now, because that sets the wrong expectation. It's very volatile. A lot of the stocks are volatile. For a while, they weren't going up, they were going down. So, and we're going to get into this week in the weekly video to talk about why investors are terrible and fail at their goal of increasing their wealth. And I was that person. So, one thing I want to stress is most of the things I'm doing in the newsletter are speculations. There are some investments in there. I've got a infrastructure play, renewable energy play that's a long-term investment. I'll probably hold it forever. It's just keeps compounding capital and kicking out cash flow. So far, so good. There's things like that. If I buy them at the right time when they're cheap, then, what's my effective dividend yield on something I bought, that was 50% lower and keeps increasing its dividend, and it currently kicking out about a 5% dividend yield. To current shareholders, it's probably double digits for me. So, it's the same thing that you look at like Warren Buffett when he bought Coca-Cola for Berkshire Hathaway many, many years ago, when it was very cheap. What's his effective dividend yield per year? 40, 50%. He's not going to sell that stock, even if it's overvalued, because the cash flows, that's one of the secrets to success in investing is what you pay for the investment. That's where the money's made. But anyways, I just wanted to touch on that because things are going pretty good. And right now things are breaking out all over. We're seeing a lot of the resource stocks turn upwards, or 50, 200-day moving averages, the 50 days crossing the 200 days. Do I think things are overbought? Yes. Have oil and some of these other things moved too far, too fast? Yes. But I think that, I'm not know if I'm ready to say the bottom's in, but I've been allocating more money to these areas. And longer term, if you have a long-term perspective, a lot of these stocks are pretty cheap for where I think they're going. Okay, let's get into the stuff here. John's reality check. Like I said, we're not going to talk too much about different things this week, but we'll focus on this study that I found, which I thought was intriguing. It was just great. Individual investors as a group. Now, this is as a group. This isn't directed at any one of you people out there. There's a certain amount of people that don't understand that when I'm talking to the group, it doesn't mean I'm picking on you individually. So I just wanted to clarify that because some people don't get it. But individual investors as a group have no idea what they are doing. Fidelity Investments conducted a study on their Magellan fund from 1977 to 1990 during Peter Lynch's tenure. If you don't know who Peter Lynch is, he's probably one of the most successful mutual fund managers of all time. He ran the Fidelity Magellan fund for these 77 to 90. He wrote the book One Up on Wall Street. He's an icon in the investing industry, money management industry. Now, he had the benefit of being in a time when the markets were going up, but suffice to say, that's not, that's neither here nor there. His average annual return during this period was 29%. So that means all the ups and downs averaged out each year. The average return was 29% a year. Now, here is what is interesting. What Fidelity Investments found in their study was shocking. the average investor in the fund actually lost money. So think about this. If you'd have put your money in 1977 and not touched it, through all the ups and downs, you would have averaged a 29% return in the fund. But guess what? The average investor in the fund lost money. Do you want to know why? Because I'm going to get into that in another slide, but I'll just give you the punchline right here. Because most of the people that bought into the fund, you know, they would get like Money Magazine, it would rank the funds, right? So they would buy at the top. They would buy the year that the fund was up, you know, 30 or 40%, and then the following year the fund was down, and then they would sell. They chase performance. Cannot do that. I'll get into some of the reasons why people fail, but that's why, if you were asking the question, you know, how can this guy be returning 29% a year in the fund and the average person's losing money? That's why. They'll look at the start of the year. This is before internet trading, guys. So you'd have Money Magazine or Fortune to come out with the rankings, Lipper rankings of mutual fund performance. They do big cover story, Peter Lynch, the king of mutual funds or whatever, you know, and all this money would flow in after the guy had a good year. It's performance chasing. This is what pension funds do. This is why most people don't make money. This is why Warren Buffett's a billionaire and the average person is a schlub when it comes to investing. So here's why right here. Individuals make decisions every day with their emotions assisting their judgment. Now, we've talked about this before. You cannot do this and be successful. It is part of who we are as human beings. That's exactly right. This is some of the bias that you have to fight against. Unfortunately, making emotional decisions can be a detriment in the investing world. Well, it is a detriment. So why do investors fail? Well, performance chasing, we just talked about that. That happens nowadays, and it's even worse now because you have 24-hour news, you have social media, Twitter, Facebook, everything else. So anybody that's doing, you know, Dave Portnoy type situation, this guy gets elevated on YouTube or Twitter, and everybody's listening to what this guy says, and they're following it, or whatever. And that's what people do. You know, they want they're quick bucking it. They don't understand because they don't have well, I'll get into how to get around this stuff, but that's what they do. They chase performance. So you're always buying at the top if you're doing that. They have a casino investing mentality, like investing's supposed to be fun. No, investing is not fun. It's not like, you know, model trains or playing tennis or going hiking in the woods that you get for enjoyment. It's work. And if you work hard at it and you're good at it, you get paid. If you don't put any time, it's like any job or anything else that you would get paid for. If you're crappy at it and you don't put any time into it and you do it half stepping, then you're not going to get paid. Just like if you're at your job and you weren't doing your job, you'd get fired. Well, and you wouldn't be getting paid anymore. It's the same thing. It's not like going to Las Vegas and blowing $5,000 over the weekend. That's not what it is. The Me Too lemming investment strategy. So of course, most people don't know what they're doing. So what happens is you get a job at a company and they have automatic enrollment in a 401k plan. And so unless you opt out, so this money is going into, typically what it goes into, like if you're in Fidelity, you're going to retire in 30 years. They have a 30-year balanced portfolio, right? So it's supposedly balanced for people that are going to retire in 30 years. So your money just goes into that and you're thinking to yourself, you start talking to your coworkers, the other person that doesn't know what they're doing either, you know, or your ex-brother-in-law at Thanksgiving, you know, hey, what do you do with your 401k money? You know, you're talking to people that don't know anything and have not demonstrated that they have been successful investors. That's why I talk about going and finding the most successful investors and emulating what they do. Learn their secrets. Learn what they do. They're not secret. They publish it. They're very vain and they're egoists. They publish books, papers, investment papers, annual reports, go on videos. I mean, I've named the names before: Howard Marks, Warren Buffett, Charlie Munger, Stan Druckenmiller. Goes on and on and on and on. These people are all billionaires. What is the common theme? Okay, take the time to learn that. Don't go ask Sally the admin what she's doing. She doesn't know anything. I mean, she might be a great, nice person, But that's what happens. It's the Me Too. And, or, your ex-brother-in-law at the, family, or doofus, I shouldn't say ex, the doofus brother-in-law who's talking about how much money he made in, the latest IPO, and then that gets your juices flowing. Don't do that. News-based influence. So people with the 24-hour news cycle and with the ubiquitousness and availability of Twitter and all these other social media avenues, people get influenced. And then, you can trade right from your phone. So, well, they said that, I was watching this video on the way to work on the bus, and, this guy on CNBC said the Fed's going to raise interest rates. And I heard that when the Fed raises rates, stocks go down. So they go and sell all their stocks. I mean, this is just an example. Or I heard somebody say that the earnings for XYZ company might be, down 5% from the analysts' estimates. So the stock's going to drop. So I'm going to sell. I mean, that doesn't work. And then you're trading in and out, you're racking up commissions, you're in and out, in and out. It's not how successful investors do things. And then you have like fear and greed investing, right? So fear of missing out. We have this huge rally going on now. It's way overvalued. It's moved way too far. But people, like I said, inexperienced people, I've seen this now. I've been around long enough where I've been through several market cycles. And I've seen people get sucked into the same type of situation. I've seen all these Robinhooders getting sucked into what I saw in 1998, 99, 2000 at the tech bubble, 2008, the housing bubble. You remember housing prices could never go down. They never went down in the history of the United States. Why would they go down now? You saw what happened. Look, guys, nothing goes straight up. These are common sense things, but the emotions take over. The greed takes over. The fear of missing out takes over. Your doofus brother-in-law, half in the bag at the Christmas party, family Christmas party, bragging about how much money he's making, and your wife's going, well, how come we only have 11% return in our funds? And Roy, the doofus, was bragging he was up 150% in whatever, in Amazon or whatever he's doing. Don't fall into that. That's what happens, though. The odds are against you already. I remember one of the top money managers, I can't remember which one it was. It may have been Ray Dalio or somebody. But anyways, he said it, or maybe it was Paul Tudor Jones. I can't remember. One of them said, listen, if you think that you're just going to come home after working 40 or 50 or 60 hours at your job, do all your chores, play with your kids, get some downtime for yourself, and then devote, an hour on a Sunday afternoon to reading, Forbes magazine, and then coming up with a coherent investment strategy that's going to beat me, you're deluding yourself. And that's exactly right. These people all day think about what they're doing, okay? They have access to hundreds of analysts, people with PhDs, supercomputers. This is what they do all day professionally as a job. So you're not going to get an edge on them by buying Amazon. All the information is priced into most of these stocks. You have to seek out areas where there's an information deficit or in areas of the market that these people can't play in so that you can get an edge or an advantage, okay? So just to illustrate, a 25-year study done by Longboard Asset Management, which looked at 3,000 stocks, basically the Russell 3000, from 1983 to 2007, showed that the odds are against you for randomly picking winning stocks. I mean, if you just randomly pick things, and that's what most people are doing when they're just buying things, okay, because it's going up or whatever. The study showed that 18.5%, these are talking about the stocks, random stocks, lost 18.5% of the stocks, lost at least 75% of their value. 39% of the stocks lost money during the period. 64% of the stocks underperformed the Russell 3000. This is in that period of 1983 to 2007, which is basically 24 years. Only 25% of the stocks were responsible for all the market's gains. So it's your job for the limited time that you do have to seek out those type of stocks. And so that's why we talk about 100 to 1 in the stock market. Chris Mayer's book about 100 baggers. What are the commonalities? It's pattern recognition. What are some of the commonalities? It's the same thing like playing poker. Okay, certain hands should be played a certain way based on the probabilities of playing them tens of thousands of times of what the outcomes are going to be. It's the same thing. Okay, you got to buy stocks, invest in companies that have a moat, that have a product, that have good management, that can be trusted. That's one way. Another way is buying cyclical industries at the bottom of their cycle that are getting ready to enter an upcycle. That's more difficult, but can be very profitable. These are some of the things that Thomas Phelps talked about in his book, 100 to 1 in the stock market. This is some of the things you can read about. You have to understand where you're at in the cycle of the market, okay? And then you have to buy things and hold them and let the, you have to recognize you're buying pieces of business. Like we talked about last week, in order to create wealth, you have to be an equity holder. So when you're buying a stock, if you're thinking about just flipping it, like you're playing around, flipping baseball cards or something like that, then you're just gambling. But if you're analyzing the business and buying a business at a good value that has prospects of growing over time, then it can compound your wealth. Most people cannot and will not do this. That's why they're unsuccessful. And that used to be me a long time ago. I think it's either you're born with these things or somebody sits it down and pounds it into your head. But the average person, you have to go through a process and learn these things, become wise. The problem is you eat up so much time that you could be compounding wealth. That's the whole point I'm trying to make here, guys. I would have liked to learn what I know now. I'd like to start over with zero and have all the knowledge I have when I was 18. Believe me, I'd be on TV every day. I'd be a multi-billionaire. But it's not like that, right? So take the wisdom. I'm telling you, get control of your emotions. Learn. Success leaves clues, okay? Your future is who you hang around with, okay? Educate yourself, read. So what can you do to improve your odds? If we're talking about the average person, average investor doesn't know what they're doing, what can we do to improve our odds, to make ourselves better? First of all, you got to have a personalized investment plan. It can be 40 pages, it can be 1 page, but write it down. What are you trying to accomplish? What's your risk profile? Do some self-introspection. Write this down, okay? I don't like risk. If that's you, write that down. If I'm capable of taking more risk, I'm trying to retire by the time I'm 40. I'm trying to have a comfortable, lifestyle. I'm trying to get some wealth for my kids. I want financial freedom. Whatever it is, write it down. Write about risk, okay? Write about things, I don't like real estate. That's me personally. I don't like investing. It's too much work. I don't like it. I like equities and investing in businesses. Here's something that's very important. I keep emphasizing this, and I guarantee you that 95% of you guys are not doing this. Educate yourself. How do you do that? You must read. Charlie Munger said this, and I agree with him. I've never met anybody that knows what they're talking about or successful or is intelligent that doesn't read a lot and doesn't think about what they read. If you're sitting around, watching stuff on Netflix, or, I see people, hey, does anybody on Twitter, anybody know a good series on Netflix? I've watched just about everything else. Well, how many books have you read? Now, if you just want to be a schlub your whole life and a wage slave, that's fine. That's most people. And there's nothing wrong with that. The world needs garbage men and bartenders and accountants, and bookkeepers. That's great. Everybody can't be independently wealthy or, be independent. But if you want to accumulate wealth, if you want to break free, then you have to do things differently than what everybody else is doing. And so, picking up a book or getting your Kindle and laying on your couch and reading 500 pages a day and creating a lattice work of knowledge that you can draw on and start thinking about, and ideas start pouring out of your head. Nothing changes through human nature. The cycles repeat. If you don't know anything, you can not literally, but figuratively speak with the greatest minds in history. They've put their thoughts down on paper. Why wouldn't you want to do that? Just by reading books and thinking about what these people are saying. Read biographies, read history, read anything that interests you. That's how I get the knowledge that I got about the energy industry. I'm so fascinated with mining and energy. I just love it. I love the machines. I love the whole concept. I love the technology, so I'm very interested in it. So that's why I kind of specialize in that. Okay. But that could be anything. And then you start knowing it. That's why I know so much about, the things that I know about. And you have to build on it. It's like it compounds, right? It's like wealth. Your knowledge compounds over time, your wisdom. As Charlie Munger says, strive to go to bed wiser than when you woke up in the morning. And the only way you're going to do that is by learning. How do you learn? By reading, taking in information. And I'm not talking necessarily about blogs, that can be part of it, or messing around on social media. I'm talking about picking up a book, The Rise and Fall, you know, of the Roman Empire, Marcus Aurelius. Read a book about welding, whatever interests you. It will lead, one thing leads to another. Understand the concept of compounding and its relation to time. If you look at Warren Buffett's wealth, how it compounded, it really started going exponential over the last 5 or 10 years when you start getting into the billions. They have compounding calculators on the internet. You should go look at this and understand it. If you put so much money in and compound it at this rate, what will you have in 10, 20, 30 years? If you change the percentage or the starting amounts, or you add, they have all kinds of different compounding calculators. And you'll start understanding why you need to start early and why you need to be a success at this. You can create tremendous amounts of wealth with starting with very little money if you understand these concepts. This is one of the most important concepts. The money is made when you buy an asset or buy equity, not when you sell. What do I mean? People say, well, what does that mean? When you sell is when you get the money. Yes, but what you pay, if you overpay for things, your returns are going to be lower. This is the whole point of the CAPE, cyclically adjusted PE ratio. If you're overpaying for something, and it's just been shown over and over, after the tech wreck in the late 90s, 2000 era, there was companies like Microsoft and stuff that were churning out, their profits were going up every year, but the stock didn't move. Why? Because they had such a stock market bubble. The stock had gotten so far, the valuation of the company had got so far out of whack with the actual business. It took 10, 15 years for the actual business to catch up with the stock price. So if you overpay, it'd be lucky in that case that you didn't really lose a lot of money, but nothing happened for 10 years. You have to buy things cheaper than they're worth. And that takes knowledge. It takes ability. That's why, going back to point number 2, that you have to think, read, and educate yourself. You have to understand these concepts of how to value a company, historical valuations. Okay. You have to understand and read, papers. People have done these back studies. They've done all the work for you. You just have to go out and find it, showing that if you buy things at a certain discount, that over time you can expect to see this type of return, against if you overpay, that you'll have suboptimal returns. This is a known fact. It's not in dispute. Write down why you bought a stock and revisit it occasionally to ensure your thesis is correct. I tell people to do this. Keep a log, keep a journal of why you're buying these companies. Oh, I bought this because John Paul and me on the internet, or Harris Kupferman said this. I've ran into this, I've seen it on Twitter. This so-and-so said this and he was wrong. He's an idiot. Well, it's your money. Yeah, I get ideas from all kinds of people. It doesn't mean I just go out the next day, pick up my phone and say, give me 100 shares, whatever, because so-and-so said it was a great idea. If I think it's a great idea and it's somebody I respect because they've had other great ideas, I will go take some time and look into the idea. What's the thesis that the person is operating from? That's the whole way I got the whole AR thing. I didn't come up with the idea. I saw it on Twitter with Nick Jones and Contrarian 8888. And these guys were talking about their thesis around it. I looked at it. Yeah, I agree. Got in. That, that I'm not just blindly buying. So, and I wrote down why. Yes, I agree with the thesis. Is the thesis intact? I revisit it occasionally and say, is the thesis intact? If the stock drops 25% after I buy it, did anything change materially with the company, or did the price change? As Buffett says, in the short term, the market is a voting machine, and in the long term, it's a weighing machine. In the end, value will out. But if you don't have conviction, and your conviction comes from your study and your research, So if you don't have conviction, you won't hold and you won't buy more. You know, people say don't buy something when it drops. Listen, if I buy a company and I have confidence in it and it drops 50% and nothing materially in the business has changed, then I look at it as a value opportunity to buy more. And I have done that and it has worked out. And sometimes it doesn't work out. But you're playing the odds. You're not just blindly doing things. I'm trying to get to that point into your head. Don't just blindly do things. Have a reason. Master your emotions. This is the most important thing, probably the most important and the most difficult thing to do, and why I think most people are not successful. You're a human being. Everybody has emotions, unless you're some Terminator 3000 or something, sociopath. I don't know. I'm not a sociopath or a psychopath, so I have emotions. I have biases. These things affect me. So you have to constantly fight against them. You have to fight to recognize them and purge them, because we're here to make money, not make a point. If you're here to make a point, you know, people say, well, some people, the best performing stocks in the last 100-some years have been tobacco stocks. That's just a fact. And if you're just trying to get return, then you had to be buying those to get the best returns over the last 100 years. I'm not saying that's the best investment. No, I'm just saying, giving an example. But a lot of people would be saying, well, I'm biased against that because I don't like the product, or the product's a legal product. You know, I'm not here to argue the merits. I'm just using that as an example. Then you're going to have to make that decision. Okay. But like I used the example after the 2008 crash, when President Obama got elected and the economy was falling apart, the market crashed, S&P was down to like 666. And I was telling people, you need to be buying in this market because the Fed's going to come with all kinds of liquidity, and liquidity and sentiment is what drives these stock prices. And everybody said, well, I don't like Obama or his policies. So they just sat on the sidelines as this thing went up hundreds of percent. They left a lot of money on the table. You can't do that. Most are not able to master their emotion, and as a primary reason most fail. Even the experts succumb to their emotions occasionally. Stan Druckenmiller talks about a time when, I have to find the exact interview or article, but basically, quick synopsis is it was some kind of stock that he knew was overvalued, his analysis, but he just couldn't help himself. So he actually, got some interns or somebody or some junior analysts to buy it for him. And it ended up losing money long-term, but he knew. And then somebody asked him, well, what'd you learn from that? He goes, I didn't learn anything. I already knew, but I couldn't control my emotions. The FOMO took over. So I had bought a position. This is a guy that's a professional investor. That's a billionaire, one of the most seasoned, experienced, and master investors, and he still succumbed to it. So you're going to too. I do it too. You just have to minimize it as much as possible. Have realistic expectations on returns. You look at Buffett or Prem Watsa, who runs Fairfax Financial. They list their returns, average return. The average return in an index fund of stocks long-term with dividends reinvested is like 9%, 8 or 9%. Okay. And then, I mentioned a couple stocks in AIA that were up over 100%. That is abnormal. That is not normal returns. People see what happened like in Bitcoin or these other, Tesla up 700% over the last couple of years, whatever it is, and they think that that's normal. That is abnormal. That cannot be. Understand what realistic investment returns are. And that goes back to compounding. Look, as long as you're getting positive returns, if you're getting 9, 10, 12% average returns over 30 or 40 years, you're going to have a tremendous amount of wealth compound. And if you have a couple multi-baggers in there, which you can do with speculation with some of your risk capital, not your main investment capital, then you can juice your returns. That's what I do. But be realistic. People say, well, hey, John, give me a stock that's going to double this year. What does that mean? I don't know. Or give me something that's going to go up 10 times. What are you talking about? No one can know that. What you can do is understand that, how business works, how cyclicality works, how some of these things work, and then, take advantage of it. Understand the difference between investing and speculating. Okay. We've went over that before. A lot of people don't understand that. If you're trading in and out, if you're hoping to, your only analysis is that I think I can sell it to somebody else for more than I bought it. That's speculation. Investing is I'm buying this piece of a business, this real estate asset, this factory, this business, because it can generate me a certain return, and I think it's going to be able to do that over a certain amount of time. You know, the value of a business is basically what you think the stream of future cash flow is from that business over time. That's the whole basis of valuing businesses. What is the stream of cash flow that can come back to me from this business over time? And then what do I pay for that stream of cash flow? That's it. And here's another one. Get your dopamine fix somewhere else except in investing your money. Goes back to that casino mentality. This is not a casino. You know, people go to the casino, they put $100 in a slot machine, the thing hits for 20,000. I mean, the hits for whatever, the flashing lights, you're getting a dopamine release, a pleasure release of chemicals that create a pleasure sensation. Get that fixed somewhere else, okay? We're dealing with your life here. You're dealing with important goals. You're dealing with, you know, this is not the place to be messing around. This is not Las Vegas. It's not a casino. It's not a resort. This is a business you're running. Treat it that way. Be serious and understand that these chemical reactions do take place. You know, you should train yourself that you should not want to feel good. You should not be, you're going to get that dopamine release when you do good. You know, what's happened in the last month in my portfolio is it's great. But, you know, you got to suppress that because this is a business. We're having a good month, a good quarter, good couple quarters, but that can all change again, right? These things go up and down, they ebb and flow. Look at the long term, look across the desert to the promised land. All right, that's the extent of this video. Not a lot to talk about. I have a lot of other things to talk about. Uranium's really perking up. Looks like, I don't know if it's the bottom. We're in a seasonal period where uranium stocks do good. I'm not sure if this is it. We've made the bottom and we're going to come out of this thing. One of the things that what I was thinking about though, is eventually hedge funds and private equity money, big money is going to come into this. And if I had, you know, $1 billion and I was inclined and I knew what I was doing, what would I do? Well, I would probably buy some long dated call options. I'd load up a bunch of call options on some of the uranium companies that I could buy, like Cameco, Kazatomprom, maybe some of the smaller ones that they have call options available. I'd go out way out in the future and, you know, go out of the money on these things. I'd get that prepped first. Then what would I be doing? Okay, I'd start making calls to buy physical uranium. Okay. However that's done, I would figure out how that's done, or I would just go out and start buying up like UPC. It's still selling at a 17% discount. You can buy uranium at a 17% discount still if you buy UPC. I think it's the current discount. And I would start trying to pull off all this physical uranium off the market and force the price up, because and create the market is so small that somebody that actually has money can do this. Then I'd start buying the stocks here and there. Okay. Once these things start to get into an uptrend, or after, you know, I'd start pushing because reflexivity takes over, right? Starts to move, the algos pick up on it, the chatter starts, more money comes in. Hey, there's an article here, there's a blurb here, hedge funds moving in and buying physical, the fuel buyers. This is what happened in the last cycle. And I expect this to happen. And the market is so small. I mean, the other day, somebody put it on Twitter, it was like, one of these stocks had a huge move. It was only like $70,000 moved the stock up 10%. Can you imagine if you come in with hundreds of millions of dollars? I mean, this is going to happen, I would suggest, at some point. So, you know, and then this thing gets going. It's like all this tinder has been built up, right? The supply situation with uranium, the demand situation we know about, supply keeps contracting, demand keeps going up, okay? And then somebody starts getting in there and basically force these utility buyers to come to the market by forcing the spot price up, just start taking material off the market and sequestering it. I mean, it doesn't go bad. It just sits in a drum at some holding facility that Cameco or somebody has, right? In a drum. You just have it sit there and just keep buying it up. And once this thing, you know, gets some momentum, then you're forcing people to come to the market. So it's an interesting concept. I think that's what happened last time the hedge funds got involved. I talked about it in my what happened in the last uranium cycle. And it was literally, guys, every single week for over a year, the uranium price would go up. Trade Tech would report it. It's up $1. It's up $1.50. It's up 75 cents. I mean, I was just like shocked. It's like, how high is this going? It would never go down. Every week was going up because people were coming in and just buying up the uranium. So it created its own feedback loop, if you will, positive feedback loop. And so I expect that's going to happen again. I think, people are always looking for trades. They're looking for arbitrage. They're looking for ways to get outsized returns. I wouldn't be surprised if that happens again at some point once this thing gets going and this feedback loop gets created. And, I'm not saying that's happening right now. I'm just saying that's what I would do if I had, $1 billion or $500 million. I'd probably start pushing it that way. And, people talk, they make calls, watch the show Billions. I mean, it's a good show. It kind of gives you some, it's a little bit dramatized, but these people all talk. And when they want to get in on something, they go in. You just have a dinner. It's an innocuous thing is mentioned. What are you guys doing over at Axe Capital? Well, I got talking about this uranium thing. This is what I'm doing. They go back, they get their analysts on it. This looks good. Let's jump on the coattails. All of a sudden the spot price goes to 45 or 50 and the utilities are going, hey, wait a minute. The days are over. There's no supply out there. And then this thing starts getting its own momentum. So I suspect that will happen at some point. All right, guys, that's it for this week. Thanks for the subscriptions. Thanks for the channel growth. Appreciate you guys a lot. And we're doing this, we're successful because you're making us successful. So I just want to say thanks for that and appreciate your support. We'll talk to you next week.